This is Don Kaufman, and you are watching the TheoTrade evening video, January 12th, 2022. This has been just a low skew, kind of low option volume slop fest of a trading session. Sure, we've rallied off of some of the recent lows that we've seen in the marketplace, but today's price action is anything less than conviction in the markets. And again, as I said, it's like low skew, low volume. I'll explain precisely what I mean by that. Let's start with the S&P futures. We're just about an hour after the close. SPOOs finishing up very mildly. I mean, is this even a move? 0.3%. The Nasdaq up some 65 handles over here. The Russell kind of defects a bit lower. As I said, it's very divergent. That's why I call it kind of a slop fest. If you really want to see a slop fest, though, why don't you come over here to the advanced decline line? One of the things that I continually mention here is that this advanced decline line, we have not seen a relatively high correlation coefficient in quite some time. And again, I am just wild about this because the marketplace gets trapped within given volatility ranges so long as we're seeing like 50-50 advanced decline lines or like 70-30 kind of slop fest. You know, even in the midst of some of the sell side activity. In fact, let's go ahead and bring this up inside of the S&Ps. Even in the sell side activity that we saw a little bit of last week and the beginning of this week, that was nothing more than tech slipping to the downside. And at the exact same time, and as I say, tech slipping to the downside, obviously the Qs getting hammered have rallied back. But at the same time, the Qs were getting hammered. Obviously, the financials were divergent to the upside. What else was divergent to the upside? Of course, you're seeing, again, the energy sector, which is just blistering move to the upside. So at this point in time, you know, be on notice that this kind of slop fest of a marketplace could come to a screeching halt, okay? And that markets right now could be on the verge of snapping into degrees of correlation. What would drive us there? I'm going to tell you exactly, right? First and foremost, when you start looking at the energy sector itself, okay, is divergent from oil. So they're decoupling right now, where oil, right? Oil, it's just been straight up. I mean, let's not even worry about back here at the 64 level. Let's just look at the move roughly since 70. It's almost a straight shot up to the 83 handle. But at the exact same time, okay, take a look. All right, so we've had this, you know, huge move to the upside. Nevertheless, today, the energy sector is massively unchanged. And I would assume that this decoupling is kind of forthcoming, and the decoupling of both the energy sector, again, and the financials. So when I say decoupling, these two sectors have been rotated into in an extraordinary fashion. I would look for, again, both the financials and energy sectors to come off a little bit. But at the exact same time, the big question mark here, okay, the sell side activity in the bonds. And again, there is a lot to think about, you know, halfway through this trading week. So you get this wild sell side activity in the bond. We get a little bit of a bid for 2 days. Okay, far be it from me to say this, but it looks like the bonds could continue to come off. And if the bonds continue to sell off, they're going to come after tech again. Why? Higher interest rates. As bonds sell off, that takes rates inversely proportionally higher. So as the percentage interest rate, you know, climbs, they're going to come after tech in a big way, right? So we are on the verge right now of possibly seeing, again, you know, hey, listen, the financials have been rotated into, the energy sector has been rotated into. Nevertheless, if bonds continue to sell off, okay, I fear not only it will take down tech, but it'll actually take down other major sectors, and we'll start to see a little bit more flush in terms of the S&Ps. Speaking of the S&Ps, it speaks volumes to look at the 30-day 1 hour. Once again, we're just right back to the top side of a range that we've been in. This is a fairly hectic and volatile range. I keep warning of, hey, eventually we're going to test back down to the 4,500 level. But at least at this point to the upside over here, there feels like there is a little bit of like resistance to popping to the upside. And again, the craziest probably part of this is I call it like a, you know, this low skew, low option volume kind of slop fest in the marketplace. One of the craziest things that we've seen is even volatility has actually come off a little bit. And why I'm so perplexed by volatility coming off, Okay, there has been phenomenal movement overall inside of the marketplace. I mean, just take a look, for instance, here at the SPX, the mother of all products. All right, so we're supposed to have just shy of an $80 move. Specifically, it was about a $78 move higher or a $78 move lower on the entire week. What have we done thus far? Granted, it's only Wednesday afternoon, and we've already cracked the lower edge of the expected move today. We came a hair shy of the upper edge of the expected move. I don't know, what's 150 points amongst friends? We've been everywhere. Right now, though, okay, this area inside of the SPX kind of leaves something to be desired here. There's still quite a bit of volatility that we're likely to see play out in Thursday or Friday of this week. Now, for the big conversation piece here, and I've said it a couple times, there's a low option volume, okay, that is kind of plaguing this marketplace. And by low option volume, okay, first, I went and I looked at the S&P futures, and one thing really surprised me about the S&P futures, their volume is not necessarily low. Okay, the S&P futures are cresting over 1.5 million contracts a day. You realize, even in the midst of some turmoil, okay, look, the S&P futures in a lot of average days, we're in the neighborhood of a million, maybe 1.2 million contracts trading in the S&Ps. So what gives? Because you're taking a look at this, and we're upwards of 1.5, 1.6 million contracts trading in the S&Ps, which is indicative, if you will, of a lot of hedging activity, okay, from institutional money managers, market making firms, proprietary trading firms. Listen, somebody is hedging out there. That's why the S&P volume is so substantial. But at the exact same time that the S&P volume happens to be substantial, look around a little bit. I'm going to start here in the SPX, and I'm going to open up on thinkorswim the option statistics. Okay, why am I opening up option stats? Well, one thing that I found was really, really interesting, and I don't think a lot of people are going to catch this. Okay, the volume in the SPX is actually it's rocking. It's 1.6 million contracts. There's a huge amount of positioning going on in the SPX, but at the exact same time, then I start to look at stuff like Facebook. This thing is only doing 75% of its normal option volume versus the previous 5 days. So like, what gives? Retail, they're nowhere to be found. I want to make this clear. Retail traders, they're not engaging right now in Facebook. Go take a look at NVIDIA. Retail traders, this thing's only doing 65% of its normal daily option volume versus the previous, again, 5 days. So if we're supposed to do, we did almost 500,000 contracts, okay? This is a product that's been doing considerably more. It's been doing on most days, 700,000, 800,000 contracts. Retail, okay, they're gone. Take a look at something like Tesla. Tesla was rocking today. Tesla didn't even hit its volume numbers. Everywhere you look in tech, the retail trader has disengaged from the marketplace. Meanwhile, you look around at some of the major index products, and I can't help but notice it's rocking out there. Look at the sizzle index in here, right? Taking a look over at the spiders. Now, the spiders, okay, it does happen to be a retail-friendly product, but even the spiders, they're doing 1.2 times the norm. So all of a sudden, in the major ETF and index product, you have an abundance of volume. In the S&P futures, you have an abundance of volume. In the products that are all retail driven, they're gone. Be on your game. The dip buyers, okay, have just diminished overnight. And again, I want to actually give you some statistics, right? And for those statistics, first and foremost, I figured this is kind of a fun one over here. If you look at the date very carefully, it's not a mistake. I actually threw up last year to begin with here, though, okay? But this is last year, okay, at a very, very similar time frame. So this is January 14th. Last year, we were doing like 47 million contracts. Okay, January 15th, we did 50 million contracts. Like, whatever, man, that's a year ago. Yeah, but I want to show you the difference, okay? In stark contrast, this is last night. This is January 11th, 2022. We only did 35.5 million contracts, okay? And again, this is last night. 35 million contracts. You're like, okay, so whatever. All right. The 2022 average right now is basically just about 40 million. All right. The January 21 average, okay, was 44 million. We are way off of our game right now. We're off our game looking at 2022. We're off our game, obviously, looking at January of 2021. Retail has dissipated. Okay, dip buyers have seemed to actually have contracted a little bit in terms of overall volume. So that's what I mean a little bit by like a low option volume kind of slop fest of a marketplace. Right now, this seems to be institutional money managers. This seems to be proprietary trading firms and market making firms. They are very much back in business. Last thing I want to mention on this particular front, okay, this number literally just came out seconds ago. SKEW. Now, SKEW looks like a bunch of dots on your screen. So if you want to bring up SKEW, you got to switch your chart from candle over to a line chart. This is SKEW. SKEW has absolutely collapsed. What does that mean? Okay, what SKEW actually measures is implied volatility. Now, it's implied volatility. I'm just going to script it up here really quick, okay, and make a quick point with this. So you got implied volatility. That's the IV for puts. Okay, then you have IV for calls. Now, the SKEW measures exclusively SPX, okay, 30-day. So SPX 30-day implied volatility of the calls versus implied volatility of the puts. What is SKEW actually measuring? Okay, it's measuring the differential of implied volatility from puts to calls. Meaning if the puts are trading for a high premium versus the calls, like if these puts are trading, for instance, of 30% IV and the calls are only trading for like 11% IV, that would be considerable SKEW. The SKEW, though, okay, has dissipated. So what's going on? Well, one of the rationales I have is that traders could actually be selling puts to close, meaning that they had hedged, the market sold off a little bit, and they sold puts to close. In any way, shape, or form you want to look at this, to me, it opens the market up to two-sided trade. Okay, why? Why do I say that? Because back here at a 155K SKEW, everybody owns puts. They are hedging to the hills. And the second we move down, no one cares because everybody has reduced every amount of risk. Now we're in big time contrast. Now we're back down to a 135 SKEW. Now, if the S&Ps were to sell off, everybody isn't necessarily hedged, that they've actually let some of those hedges go. It is a wild dynamic, though, that we're seeing right now. Retail, okay, has pulled back. Institutional trade has actually picked up quite a bit. SKEW, though, has fallen. People, this is exactly why I'm calling it like this, low SKEW, low option volume, market of a slop fest. Look for some wild two-sided action to kind of transpire in the days to come. If CPI didn't scare you, well, this market absolutely should. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.